Yeah, so we look at Kitco and gold here. We're up, it has come down. And again, that's interest rates are smacking it. One thing that really helped the gold trade this year when, gold started to really move in February and from just over 2000 and went to over 2700 and move almost 35% was the fact that the 10-year bond, you can see it didn't quite peak in February, but, it peaked in April and went from 470 down to 360. That really helped the gold trade. So these rising long-term rates doesn't mean it has to kill it, because when you look at gold in 2023, when you see the rates went up like that, gold actually held up pretty good. It didn't go up gangbusters, but it went from about 1800 and by the end of the year was about 2000. So it doesn't have to kill it, but it definitely is going to put kind of a lid on it right now. And I still think we need more of this consolidation. The gold stocks are acting very poorly. You can see now they're below the moving averages again. That doesn't again have to mean the end of the world in 2023 that happened, but that probably means we're going to do nothing on the gold stocks for a while. I have to be very honest. The issue now with the stock market is this the start of the move down? Because remember, it's one thing that's going to happen on this move lower in the stock market if we're in a topping formation now is at some point, and I'm not saying that maybe those long-term rates will blow out before that, and that's what will cause a big move downwards. But at some point, gold starts getting the flight to safety bid, right? Remember, risk assets are still high in price. We're only a few percent off the tops. Like I'm sure a lot of you know about where is it? Uh where's the market cap of this thing? About the no, I think it's the one that's got the $1 billion, the fart coin, you know, well, it's just top of let's do it at the top here. Fart coin. Uh, fart. Yeah, Farcoin, $1.2 billion market cap, up another 23% today. You know, so this is like if you could, if someone wants to short this thing, I would definitely look at short at this point. So like this is now, by the way, worth more than 90% of the companies in the United States stock exchanges because it's got like this $1.2 billion market cap. Because most companies trade under $1 billion, right? I know we think of these mega companies like Microsoft and Amazon and Apple and Nvidia and Tesla, etc. But like it's these most companies are like small companies that trade at like 3, 4, 500 million, 800 million, whatever market caps. So anyhow, so we can see that. So I just think now with these gold stocks, no, we're oversold. You can see last time the RSI got to this level just a few weeks, about a month ago after the election, there was a good bounce. So you don't sell down here. Actually, you should be buying down here. Look what happened when the RSI got oversold at these levels here. Those all ended up being buying opportunities over the next year. And you can see back in 2023, when it got this oversold or near this oversold, it ended up being a very good rally for a few months. So but I just think that because of interest rates moving higher, the strength in the dollar, we'll look at the dollar in a second. I think because of all of that sort of thing, we're going to see this just kind of consolidation play out here in the gold and gold stocks. Silver is basic, you can see right at the moving average as well. But again, we're getting oversold and near bouncings. And of course, we are seeing kind of what I've talked about recently, the dollar milkshake theory. We are seeing that, play out. For my Canadian friends, we all know that the Canadian finance minister resigned. Trudeau is fiddling like Nero. And you can see this is actually let's get a longer term chart of the Canadian dollar. I am Canadian, so I always take some interest in this. Yeah, it looks like we're going to the 2015, 2020 lows in the dollar. And if that breaks, really there's nothing to these lows, all-time lows of 2002 to 2003, so that, which would be like 62, 63 cents, and I don't know if that's going to happen. A lot of it has to do with the incompetence of the current regime in Canada. And a lot of it has to do with, this kind of whatever, you're going to get shake theory trade. But again, like I kept predicting the last month or so, the gloss is going to come off the Trump trade. The market's just open now as I'm doing this. You can see the Dow's up 328 points, regaining some of the losses from yesterday. The VIX is down, 6 points overnight. So because, now we're going to have this fight over this omnibus bill. There's going to be the tariffs. Remember, the tariffs to me are going to be the very interesting thing to watch. And I'll tell you why they're going to be very interesting to watch, in my opinion. Okay. The reason I believe that the tariffs are going to be so interesting to watch as kind of an outsider watching all this is that let's take three or four countries. Now, UK doesn't look like they're going to have any tariffs slapped on it because the US, Trump has this rudimentary way of looking at economics where he's like, if Canada has $100 billion trade surplus with the United States, he's like, oh, they're ripping us off for $100 billion, right? So that's the way he looks at it, right? And if he does that, like it, it, like he does that, like it's like, no, look, you're the reserve currency of the world. Everyone owns your debt. The rest of the world has been supporting your fiscal recklessness, for years. China owns $1 trillion. Japan owns $1 trillion. Canada owns 300 billion. The UK owns 500 or 600 billion. So those three countries alone own $3 trillion worth of debt. And what happened to they said, okay, Trump, you want to slap our tariffs on us? We're dumping that. And if you dump 2 trillion, 3 trillion overnight, these interest rates, these interest rates spike like crazy and it kills the economy. Now they don't do it because of self-interest, because it kills the global economy. But what happens if they just say, well, you're going to hurt us with these tariffs anyhow? So we're going to just do this because we don't care. And it becomes like, I don't know if a lot of you know about the Suez Canal, but it becomes like the Suez Canal moment where the US gave the Brits an emergency loan after World War II. And then in the early 50s, when the Suez Canal was handed back over to Egypt, the Brits wanted to keep control of it to keep oil flowing to the UK and to Europe. And they basically started, they had this, actually, they had a reason for doing this. It wasn't just unprovoked. The Egyptians wanted to nationalize the companies that ran the Suez Canal, which were British owned and controlled, right? So they didn't want that. They wanted to at least keep the control over that with their own companies. So they went in there, and then the US was like, we're totally against this war. And if you don't stop, we're going to dump all your bonds. And at that time, the UK was basically bankrupt coming out of World War II. And, that's the time when all of their colonies in Africa, in the Caribbean, started having independence because they couldn't afford to keep them. Of course, India came independent right after World War II. So this is all these things that occurred. And I would say that at some point, the US is going to have its Suez Canal moment where these foreign countries are going to say, look, you're not as strong as you think. You owe us trillions and trillions of dollars. You're $36 trillion in debt, and we're going to dump a lot of this. And, you're only 20% of the global economy now. Like after, in the 60s and 70s, the US was like 50% of the global economy. So you're going to keep shrinking, especially as these Asian economies keep growing at a faster rate as a percent of the global economy, and we're not so dependent on you more. Like in South America, for example, all those resource-based economies, Brazil, Chile, Peru, Colombia, etc., they're all exporting way more to the United States than way more to China than they are the United States, China and Asia, because they need those natural resources, especially like building roads, building new apartments, et cetera. So that's the kind of interesting thing about it. So anyhow, I guess I'll end it off here. So the gold stocks look to me like gold's up $20 today. You can see it. It could still base in here, but it just looks like to me that it really needs to kind of like still consolidate the gold stocks. It's going to take a while. There has been technical damage done. Like I said, it broke the 200-day moving averages. And my gold service, I own Newmont, and I was stopped out of it. So I'll look for something else to add. You know, I know some of you subscribe to that service as well. Oh, and the last thing I'll end off on here. I'm talking about potentially shorting. So one short I'm really interested in, I'll give you a way to free people. I haven't done it yet, but this is KKR. This is a leveraged buyout firm. So let's go look at this over the last 15 years. And you can see it's gone from, single digit stock. It came public in 2010 and it went to almost 160. It's at 146 right now. Let's go take away the log scale. You can see how parabolic it is. And this is not a high growth tech stock. This is not AI. This is not a chip company. This is not crypto. This is a buyout firm. So, and if you go look at every, we'll go back to the log scales. We can see every stock market drawdown, like 2015, KKR went from 20 to about 10. 2018, and went from about 27 to about 17. It went from over 30 to about 15 during the 2020 smash. The 2022 bear market, it went from 80 to almost 40. This thing goes down about 50% on these like 20, 30% drawdowns in the stock market. So there's a good chance that if we get a 30% correction in the S&P, this could be a $60 or 60 to $70 stock. So, that's more leverage, more downside. You don't have the premiums of the puts like you do for Microsoft or Amazon or whatever. So you're going to see this. This is going to be part two. I ended part one. I actually hit the button by accident, but I'm like, both are so long. This will come out on the Friday. The last one will come out on the Thursday. So, we're just talking about the smash in the markets, the Fed not raising rate, or sorry, not cutting rates as much, etc. And I hope you enjoyed these two videos. And like I said, I do think there's going to be a bit of a bounce back here. Just the feeling of it. It feels like almost just something that's going to last, like it lasted like a day. It's an overreaction, especially because, like I said, they're not going to be raising rates. They're just going to be like basically doing nothing. That's what they did in 1996. And I'm not saying we're going to have a boom like 1996, but it definitely means that this has happened in the past where like they just stop and like cutting rates. And even in the mid 2000s they stopped the rate increases in 2006 and the market still went up for another year. They didn't cut rates. The rate stayed flat and then the market still went up for another year. Actually, it's when they started cutting rates is when the market fell. So that's the thing about it. So like in 1998, after they cut rates, they didn't keep cutting rates. They started taking those rate cuts back in 1999. The market boomed. So it doesn't necessarily mean that the market's going to roll over. And I think it was a bit of an overreaction because I still think people were hoping for another maybe 50 to 75 basis points of rate cuts next year. Not a lot, but now they're basically getting zero, and the maximum they're getting is one. And that's kind of ended that. So it's hard to know because they had basically finished cutting rates in late 2019 as well. And then let's just quickly look at that to end off here. So you can see what happened in 2019. We'll just get a 10-year chart. Well, yeah, we'll zoom in on it. See here, the rates were going sideways. So basically they had cut rates. You can see from about 225 to 150, and that was going to be it. And actually people were talking about them, maybe starting to raise rates sometime later in 2020. And then you can see this precipitous decline. That's because, COVID happened and they basically bailed out the whole financial situation again. So that's kind of where we could be here too, where, okay, maybe now for another 6 months, 1 year, they don't do anything. And if we get a big, large smackdown on the market, say, well. So anyhow, I'm going to leave it at that. I hope you enjoyed these two videos. I think breaking them up in two parts was better. And these two videos, by the way, they will be put by the end of the year as members only videos, because this is really this kind of information I do for the members. And like I said, my book got pushed back to March. So essentially all these new services I talked about that I was going to do next month, because that's when the book was supposed to come out. That will probably start in March. I'll probably keep things the way they are till the end of February. And but in March, you're going to see much more uploads to the members area. Hopefully I'll have my Substack set up by the beginning of March, and some other things. Oh, I'm also going to talk about something very interesting on Monday. An opportunity I've talked about in the past, that I still really, really like. I'm going to do the IPO in a few months. I think a lot of you will find it interesting, etc.